I use the ISM survey here. That's the part that drives the economy. And what we find is when the business cycle picks up, Bitcoin picks up. Why? It's because Bitcoin and all of crypto is driven by investment and activity. And activity picks up and investment picks up when people have more money. When the business cycle is strong, everybody has more money and things get recycled into assets, which is why the S&P, the NASDAQ, everything correlates to the ISM, and Bitcoin does too.
One of the strongest parts of Pal's thesis is the relationship between Bitcoin and global liquidity. Historically, Bitcoin has shown a very high correlation with liquidity conditions. When liquidity expands, Bitcoin tends to rise. When liquidity contracts, Bitcoin often struggles. The reason is simple. Bitcoin is increasingly becoming a global asset that absorbs excess liquidity. However, Bitcoin is also much more volatile than liquidity itself. Sometimes it runs ahead of liquidity, sometimes it falls behind. But over longer periods, the relationship remains remarkably strong. This helps explain why Bitcoin experiences dramatic bull markets and painful corrections while still maintaining its long-term upward trajectory. For Pal, understanding liquidity removes much of the emotional noise from investing. Instead of reacting to daily headlines, investors can focus on the larger macro trend, and that trend remains firmly tied to expanding global liquidity.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
But firstly, to invest in anything, you need a framework of understanding. The framework that I've used and brought to everybody is the Everything Code. The Everything Code is that idea that because of debt and demographics, we're debasing currency to replace the aging population. And that debasing of currency is the trend that matters the most. So we can see from this chart that you guys should be familiar with by now, that we are, by using the total liquidity measure, that's all global liquidity, we're growing at an 8% annualized rate. Right now, we're growing at about 10%, but average over time with the down cycles as well, you grow at about 8%. So that's 8% loss of the power of the denominator, your purchasing power. That keeps going down. On top, you'll average maybe another 3% inflation. Inflation is separate to debasement. Debasement is when the value of your currency or your savings goes down versus long-term assets. CPI is when it goes down versus the cost of goods and services. They're both different things, so you have to add them together. You'll get to an 11% hurdle rate, of which if your returns aren't beating that 11%, you're actually getting poorer every year. And this is the one thing that's making the rich richer, the poor poorer, is poor people weren't able to invest as easily. Now, crypto changed a lot of that because it's more fractionizable. It's also globally accessible. But that's where we are now. And this is all driven by the mega force of demographics. These charts, I think, are the most important charts in macro, and most people don't understand them. So this is the labor force participation rate and the births deaths rate going forwards, or the birth rate going forwards. What it tells you is demographics is destiny. It's baked in the cake. We tried to change this via immigration. It didn't work. So what we've got is a slowing of the population growth. In many countries in the world, we've got negative population growth. And we can see the size of the labor force shrinks because of it. Makes sense, right? Because older populations, less people in the workforce. And it follows it beautifully. But more importantly, that slowing of the labor force participation rate, if we go back to the magic formula, GDP growth equals population growth plus productivity growth plus debt growth, what we've got is the population side of the equation slowing. And so debt growth is increasing to offset it to maintain GDP growth. And this chart is the most important chart of macro, and it's the one least shared of all of the charts I've ever made, but it's the single most important one. Debt is a function of demographics, and that is the key trend. As the labor force participation rate keeps falling, debt has to keep going up until something changes. The something changes in the future is the AI and the robots adding to the human labor force, and that changes the entire dynamic. But that's a story for another day, and the story of the economic singularity. So now we've got this debt. How do they manage the debt? Well, they use liquidity, debasement. This is the narrower measure, Fed net liquidity. We've actually moved to a broader total liquidity in the US, which uses the banking system now, because the Fed, Scott Bessent, others have all said they really don't want the Treasury to be running, the central bank to be running the liquidity. They want it coming from the Treasury via issuance of bills, and then also the banking system. That's the changes in the ESLR, Basel III, and the other parts of the component parts that allow liquidity to increase across the system and have the money multiplier that the banking system does, because it needs to offset the government debt. So that's the game. Demographics leads to increasing debts, which leads to increasing debasement. It's a really simple mechanism. That's the framework. The other part of the framework is that interest payments are becoming a larger and larger part of the US economy. In fact, they're larger than defense spending now. And we've got a wall of interest payments to climb. Now, how you manage these interest payments is you issue more debt to pay for them. It's like getting a credit card to pay the interest on your credit card. That's really what they're doing. And to manage that process, to have the money to do it, they just print money via total liquidity. So this is the US total liquidity chart versus this. And we can see we've got this liquidity gap to come all the way into the end of 2027. Now, does the cycle end in 2027? Does it keep going? I've got other thoughts on that. My view is we probably have an extended cycle or even no cycle at all because of the debt dynamics and also the capex dynamics. But again, that's a story for another day. This is really how to invest in crypto. So when you look at total liquidity, what you can see is Bitcoin is highly correlated. Now, Bitcoin's a very volatile asset. It's more volatile than total liquidity. So it runs hot versus total liquidity, runs cold versus total liquidity. It moves around. But over time, you have a correlation of about 87%. It's a highly correlated asset. In fact, the NASDAQ is 97% correlated. So they're very driven by debasement, but Bitcoin's driven by network adoption as well, which is why it moves around a lot. It's a younger asset class. It's more volatile. It has more emotion. It's driven by different things. But over time, they follow the same trend. And Bitcoin massively outperforms that debasement, again, over time. In recent times, it's fallen behind it. In other times, it goes above it. It's nothing to worry about. It's how the world works. The other part of this is the business cycle. The business cycle, I use the ISM survey here, that's the part that drives the economy. And what we find is when the business cycle picks up, Bitcoin picks up. Why? It's because Bitcoin and all of crypto is driven by investment and activity. And activity picks up and investment picks up when people have more money. When the business cycle is strong, everybody has more money and things get recycled into assets, which is why the S&P, the NASDAQ, everything correlates to the ISM, and Bitcoin does too.
Pal also offers practical advice for investors. His message is straightforward. Do not use excessive leverage. Leverage can create enormous gains during bull markets, but it can also wipe out portfolios during sharp corrections. He warns against chasing hype, FOMO, and speculative assets without clear fundamentals. Instead, investors should focus on a small number of high-conviction positions backed by strong network adoption and long-term utility. He also emphasizes self-custody and security. Protecting your assets is just as important as choosing the right investments. Poor security practices have destroyed countless fortunes in crypto. Most importantly, Pal encourages investors to adopt a long-term mindset. Ignore short-term noise, avoid emotional reactions, focus on the bigger trend.
We've had a lackluster crypto market in the last couple of years, and one of the reasons I've talked about endlessly is the fact that the ISM was not yet rising. But now we in fact had the lowest period of the ISM below 50 in history. And that was driven by a number of factors. Some of it was slow liquidity and just the structure of the economy. But anyway, doesn't matter at this point. We've now got the ISM going up and projected to go up. Usually when the ISM peaks, Bitcoin peaks around the same period, sometimes earlier, sometimes later. There's no pure science here. You have to use a number of different indicators. And again, today I'm not going to talk about all of the indicators we use, but just to give you a rough idea, business cycle and liquidity are two of the very key things of understanding how Bitcoin works and how crypto overall works. Now, I say crypto overall because we can see here that the ETH Bitcoin cross, the year-on-year part of it, is basically driven by the ISM2. If you think of ETH, it's very different to Bitcoin. ETH is a technology. There is demand for block space goes up when economic activity goes up. Demand for Bitcoin goes up when savings go up. But over the business cycle, you tend to find that ETH outperforms Bitcoin once the business cycle is stronger. Because ETH is really a coordination layer, while Bitcoin is a store of value layer. And at this point in the cycle, it's like small caps outperform mega caps. It's this structure you can see everywhere. Junk bonds outperform treasuries. It always happens when the business cycle is on the rise. People go further out the risk curve. So that's how to understand, alts, where we are. We've seen alts stabilize in recent times against Bitcoin generally, and that's being driven by this factor as the business cycle is picking up. And so it should continue to play out. But then there's some rules of the game too. The rules that we need to understand. One is this is a logarithmic asset. Using regular charts makes it look too noisy, too messy, too volatile. But when you see the trend rate of adoption over time, you can see it's beautiful. It's a thing of beauty. It's the same kind of log adoption that NASDAQ has had, Google's had, Facebook's had. In fact, all of the tech stocks have followed this path. Amazon. They're all log adoption models driven by Metcalfe's law. So once you realize that, it takes the drama out of the price charts. And I think that's very important, having that long-term view, because I think, and I'll show you over time, where this is all going. The other rules of engagement are what I call the don't fuck this up rules. This is a volatile asset class. It's complicated. It's new. It has a bit of the Wild West about it. There's hacking, there's stuff that happens. First thing, don't use leverage. Leverage makes you look like a hero in a bull market, but suddenly you have a 50% drawdown on something happens, like what happened in October 2025, and you lose your stake at the casino. You lose your coins. Never lose control of your coins, of your tokens. This is like rule number one. Don't lose control. Don't FOMO. I know your friend is going to call you up and say, listen, you need to look at Fartcoin or whatever it may be. And, this is the best investment ever. And he's made, 10x his money and there's another 10x to make. And you start moving away from your core allocation into stupid shit. FOMOing too late doesn't work. This is a very crowd-driven asset class. The other thing is your FOMO friends or your X feed will get you to buy stuff that is disproven yet as an asset class. And those are earlier stage tokens, more speculative things, whether they're meme coins or earlier stage protocols or something that's not quite working yet. That's okay to have some of it. Have a small bag, the 10% degen bag I mentioned. That's where you can experiment and learn and try more speculative things. But please hold 3 to 5 assets as your main holdings. And I'll come on to how I think about those 3 to 5 assets. You may differ on that, but you better have the proof of why you have it. Not a hunch, not what your friend said, not because the chart looks good. You need to have proof of network adoption. Self-custody. You want to make sure that you're using a device like a ledger or you have a multi-sig wallet so people can't access your crypto in a hack. Have good wallet hygiene. Do not connect your wallets to third-party sites. Use transition wallets to move things around. Keep everything away from the internet. You don't want people to take your tokens. You don't want to leave them sloppy, leaving around. I don't really like DeFi protocols for the same reason, because they can be hacked. Never lose control of your tokens. Do that one thing and that saves you a lot. You can, I've had friends of mine who've lost a ledger for 7 years, come back and they've got, millions of dollars in it because they couldn't do anything. In fact, remember, in a brokerage house, the best performing clients they've got are dead ones because people don't do anything, which is because the long-term trend, the log regression is in your favor. And that's why you want to hold over a longer term time horizon. This is not about 3-week trades, 2-month trades. It's not about even the cycle. And I'll talk about that in a bit. It's the network adoption model, Metcalfe's law. Let it play out. Let it compound. It's really important. Zoom out, remove the noise. Try not to look at hourly charts. Try not to look at even daily charts. Try and keep your perspective long term, and it'll lower your cortisol levels and allow you to handle the stress. Remember, you're going to get 35% pullbacks 2 or 3 times a year, and you're going to get 50% pullbacks in Bitcoin maybe once every 2 or 3 years. And there'll be definitely a bear market too. And then your smaller tokens will go down 80%. It's normal. As long as those tokens are showing network adoption over time, they should recover. They outperform in a bull market, underperform in the down cycle. But your main token holdings should be something that is provable to you that you know will have a long-term store of value. Not all of them. I mean, there's very few options actually when you look at it, and I'll come on to that in a sec. And the other thing, and I'll prove this to you, is buy the fucking dip when you can. If you don't do that simple thing, you do not compound. The dips are the things, the big sell-offs, the 50% sell-off, you should be waiting for. You should have money saved for, because this is where you make the big bucks. And I'm going to prove that to you in a second. But again, here's the chart of the market cap of crypto. Again, the network adoption model is playing out. We're currently like a $2.5 trillion asset class today. If we follow the trend rate of adoption, which is how these things usually always play out, and considering the entire banking system is building on this, that sovereign wealth funds are buying Bitcoin, that stable coins are going exponential, that the US Treasury is funding the short end of the curve via stable coins, that the Clarity Act is going to get passed, and all of these things tell you the probability that this trend continues and we get to 100 trillion by, let's say, 2034. So that's 8 years' time. We go from 2.5 trillion to 100 trillion. That would be the largest wealth accumulation event in all of human history. It would also be gigantic returns. Because within this, there'll be some things that outperform, some things perform in line, and obviously a whole bunch of stuff, most of it won't do well. The thing is to be in the things that matter. And go back to the same point I keep raising, the long-term trend is the game. It's not really about the cycle, and I know everyone's obsessed by it because nobody likes to take the down markets, but it's really not. It's about compounding.
While Bitcoin serves primarily as a store of value, Pal sees Ethereum as something different. Ethereum functions more like a technology platform. Demand for Ethereum increases when activity on the blockchain grows. When the economy strengthens, investors often move further out on the risk curve. Just as small-cap stocks outperform during certain phases of the business cycle, Ethereum and selected altcoins often outperform Bitcoin during stronger growth periods. This doesn't mean Bitcoin loses relevance. Rather, it reflects the different roles these assets play within the crypto ecosystem. Bitcoin is digital money. Ethereum is digital infrastructure. Understanding that distinction helps investors position themselves more effectively throughout different stages of the cycle.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.